Hello, everyone. Thanks so much for joining us. We still have a few folks logging in, so why don't we give us a minute or two and then we'll get started. Thanks again, everybody, for joining. Hello, everyone. This is Chris Anderson with MCT. I'm MCT's Chief Administrative Officer. We've passed the 100 mark here, so I think we'll go ahead and get started. This is yet another of our series of informational presentations and documents that we're releasing to our client base to really help you folks combat some of the issues that we see our clients facing with, the current market conditions and tough profitability. We've brought together our Director of Analytics, Bill Berliner, as well as Jim Deitch, who is a member of TeraVerde, who works with a lot of our common clients. And so what we're going to be doing today is, Jim, if I could get you to go ahead and advance the slide here, I'll give you a quick introduction. Jim, again, has worked with many of our clients to help them in areas of LOS consulting, as well as helping achieve profitability through different consulting measures, and is also the author of Strategically Transforming the Mortgage Banking Industry. I think I was a co-author. I'm just missing my credit there, I think, Jim. And then if you give me
You're absolutely right.
That's right. It's coming, I know. But then if you wouldn't mind just advancing the slide once more there, sir. Bill Berliner is one of our wonderful staff members here at MCT, the director of our analytics. He's also a co-author of several different books. I really do need to write some books, I've decided. I'm going to get after that. But I'm going to turn it over to Jim and Bill here, but I wanted to let you know that for anyone that is concerned about the material that we're covering, there's going to be quite a bit of it. We may run a little long. Just a reminder that we'll be sending out this recording next week, and you'll also be presented with all of the material here, as well as contact information for Jim and Bill if you have any questions. There's also a chat function in the control panel. I'll keep my eye out to look for questions that may come up. If you have anything, go ahead and indicate the questions there, and we'll make sure that we're able to interrupt Jim and Bill when possible to get those questions answered for you. And with that, why don't we turn it over to the big guys here. Jim, why don't you take it away, sir?
Well, ladies and gentlemen, thanks so much for joining us. Chris, Bill, Ian, thank you so much for having me as a guest. I really look forward to our time together. A little bit of background. I've been a lender for 25 years and have had three mortgage banking operations. Ultimately sold them to three larger banks, and have been in professional services and technology for the last 8 years. And in working with a lot of our clients, one of the things that occurred to me is to really talk to C-level executives. And I did so with about 50 or so companies, and wanted to talk about what's on your mind for both technological transformation as well as strategic transformation. So you can see all the names of the companies that we spent some time with. And there's two at the bottom that I think are of note. One of the ones that I spoke with was Southwest Airlines. Why? Because it's a consumer-facing company that's highly regulated, and much of the cost of an airline is labor. So there's a lot of similarities there. Won't talk too much about Southwest today, but it is covered in the book. The second is a professional baseball team, the Oakland Athletics. And the reason had some interest in professional baseball is, like mortgage banking, professional baseball generates a ton of data. Every at-bat, every player result, every pitch, every outcome, and that data goes back a really long time. Some of you may have seen the movie or read the book Moneyball. And one of the comments in that book got my attention and really asked me I really got the idea to reach out to Billy Beane and talk a little bit about data-driven analytics as it relates to baseball and how that might be transformed into relation to mortgage banking. And you recall a scene of Brad Pitt sitting around the table in the movie with a gentleman who's fictionalized Peter Brand. And the discussion says there's an epic failure in understanding what's happening in baseball. You don't buy players, you buy wins, and to buy wins, you buy runs. And it got me to thinking about, is there a relationship or something similar in mortgage banking? And in talking with Billy Beane, the answer is yes. You're not really hiring LOs. You're not really hiring operations people. In fact, loans are not necessarily what you want to be thinking about. You want to think about runs, which is essentially thinking about profit. So let's just take a look at strategic transformation in baseball. About 20 years ago, Beane began to think about how can one go through and find a way to win at the least cost and keep my salaries down. That probably resonates for anyone who thinks about loan officer compensation or the cost of doing a loan, and we'll talk about that in just a minute. But here's the interesting thing, and I think it's worth thinking about as a lender. As a lender, we all have a similar product, much the same as baseball is entertainment. And we all have control of our costs. And while loan officer compensation may be at the top of mind right now, it's really compensation as a whole, which represents about 60 to 65% of every dollar of cost in our industry. So let's just look at Billy Beane's approach. They have the lowest payroll. The A's had the lowest payroll in baseball in 2018. And as of August 20th, they were one game behind Houston. 75 wins for Houston, 74 for Oakland. But more importantly, the cost per win was less than half of Houston's win, and less than half of the Angels, and less than half of many of the other teams on that chart. If you look at the Red Sox, who ultimately won the World Series, it cost almost 4 times as much for the Red Sox to win a game as it did for the A's. So the business model of the Athletics is consistently low payroll and low cost per win. But that comes out of a data-driven strategy. Every situation, every pitch. So let's look at mortgage banking for a second and the trend as to why this is really on a lot of people's minds, if not everybody's minds. So here's a look at net production income from data published by the Mortgage Bankers Association. And we see the trend, and the trend is not our friend in this particular case. So going through 2015 to the current quarter and the third quarter of 2018 was about 20 basis points. Net production income has been on a trend downward. So one of the questions that I've asked in research for the books that I've written is, how do you think about that and what's going to change? So what has to change is ultimately the trend on profitability. And if you look out through the end of 2019, 2020, 2021, for this industry to really make sense, you've got to get profitability back into that 50, 60, 70 basis point range over time. So then the question is, how do you do that? And that's the topic for today's discussion. So we'd really like to share with you 5 ideas to substantially improve profitability. And here they are, and we'll talk about each of them in a little bit more detail. The first is minimizing revenue leakage and maximizing the execution to get the most out of every loan that you do. And Bill will cover that in just a moment. Second is customer satisfaction. How do you find the drivers of customer satisfaction? How do you reduce dissatisfaction? It's a simple concept. It needs to be measured, and we'll talk about that. The third item is process transformation. Jonathan Core, who is CEO of Ellie Mae, used a term called human spackle. And his context was, after TRID came forth in 2014, many lenders were just overwhelmed with the amount of regulatory change coupled with the crisis. And as a result, instead of changing process, human spackle was used to essentially patch over some of the holes that came out of TRID, that came out of HMDA, that came out of process. It's a fundamental issue because throwing more people at it doesn't necessarily lead to better process. And the fourth and fifth items, and we'll spend a little time just kind of delving into a lender's actual data that's been anonymized, is how one can strategically manage sales performance and ops performance by employee, and then also measure the profit impact of decisions by profit, or by channel, by branch, by LO, etc. And ultimately, one of our clients said, I'm really becoming the Billy Bean of mortgage banking because I'm finding out where my profit's coming from, and I'm winning at a cost lower than anybody else, which means that my profits are higher than anybody else. And this particular lender earns 100 basis points in the current environment. So more on that in a moment. So first, to Bill, talk a little bit about minimizing revenue leakage and maximizing best execution. So Bill?
Sure. First of all, when we talk about maximizing proceeds, you want to make sure that you are using mandatory pricing as much as you can, and in turn requires you to hedge your pipelines. We'll talk a little bit about that because doing it efficiently is the key. To use Jim's baseball analogy, then it's a lot of hitting singles, getting good at bats, being efficient in the field, etc. When we talk about efficiently managing your hedging pipelines, one of the things you want to make sure you're doing is minimizing your bid-ask spreads and roll costs by using things like the most liquid coupons and actively managing your pipelines in terms of your pull-through and adjustment of hedges. Those are the kind of basic things that any good hedge advisor or any good hedge manager is doing. And hedge managers like MCT specialize in doing that and doing that to the highest possible level. And if you flip the slide, Jim. And so what, in terms of minimizing revenue leakage and maximizing best ex, you want to conduct best execution analysis of all your delivery channels, certainly. You want to use things like the bid tape assignment of trade / AOT programs, which are really efficient in that it combines efficiency and pricing benefits of bid tapes with the benefits of assigning. For example, if you can assign loans to a trade, you don't have to pair out of a particular short position, which saves you a few basis points in bid-ask spread. And when you start accumulating that, it can wind up being a significant and meaningful amount of money that you're saving.
Bill, Chris here again, not to interrupt, but just to share, I know that I was just looking at a report recently where, if we looked back as, 6 months ago, maybe, a dozen of our clients at MCT were executing through the bid AOT channel, and now I've seen that number rise substantially. I think it's 70 clients or something along those lines. Is that what you're seeing as well?
Yes, and I think it's something I think people, the AOT process goes back a few years, and what we're doing is we're really utilizing that very efficient way of distributing loans and selling loans with the bid tape process, which is something that has always provided a lot of efficiency in terms of loan sales. Yeah. And it's really combining those technologies to do it efficiently.
Yeah. So if you haven't, for any of our clients on the line that haven't spoken to your trader about that, feel free to do so, or again follow up with Bill as well.
Sure. And the next thing is you want to make sure you're always continually optimizing your investor set and including all your investors in best execution. MCT's traders are always looking at adding different investors to the process, looking at the pricing changes. Investors update and transform their pricing on a fairly regular basis, and being on top of that process is very important to being an efficient hedge manager. And then you also want to gain efficiencies through things like the trading platform, the bid auction manager, BAM, which is really taking the process that people have found to be successful, the bulk sale process, and layering on a technology solution to make it a more secure process.
And Jim, maybe a question for you. At MCT, we are often trying to balance out the number of executions that a client might have. And I think I see the number on average maybe as high as 15 to 17. So you're dealing with a lot of different investors, and dealing with them from a standpoint of delivering loans to them, may present challenges. So Jim, in your work with clients, do you have a position, or do you see clients in particular dealing with a specific number of investors, or how would you rate that experience?
So I think that's a great question, Chris, because the complexity of the delivery has to be balanced about the gain and execution. One of the things that Bid Auction Manager does, and I think the methodology that MCT is using, is to really go through and transparently let a client evaluate where that right number is. And interestingly, the gains that can be picked up by working in a disaggregated bidding area. So you're really maximizing the value of each loan as opposed to maximizing the value of the pool as a whole. I think it's the wave of the future, and it's very consistent with a data-driven strategy that says you have to understand and maximize the value not only of the individual loan, but all of the processes, people, and elements that touched it. So my guess is that it becomes more and more of a disaggregated process than perhaps it's been before. So I don't know if that answered your question directly, but that's kind of what we're saying.
Absolutely.
Okay, and lastly, a client of ours that recently implemented BAM did a study of their efficiency gains, and you can see some of a summary of some of the results on this slide. If you would like to look at the study, it's available on our website. I point you to that because it's very interesting.
Well, and Bill, I would say that the interesting thing about this study is really how we're going to spend a fair amount of our time remaining this afternoon. And it's really talking about the ability to use data to produce a significant increase in time utilization, to increase accuracy, to increase profitability and delivery, because delivery speed is, again, money because of the cost to carry the loans, both on the warehouse as well as on the hedge execution. So this is really a great lead-off strategy of minimizing revenue leakage and maximizing the best execution, because it is data-based and it is based on technology. And it's a great offering from MCT. One of the things that comes out of the research on customer engagement came from a conversation with Bill Emerson. And Bill and I spent a lot of time talking on a lot of different topics in our service with MBA together, as well as some of the other things that we serve on with respect to MORPAC, et cetera. And the thing that came out of my conversation with Mr. Emerson was he gets, for 8 years running, the highest customer satisfaction of any other lender without ever meeting the customer face-to-face. That's the only constraint that they have. And it's interesting to think that you could consistently build that relationship with never having a face-to-face relationship with that customer. It's always on the phone or by email or by other communication. So my question to Bill was, how do you do that? What are the drivers of customer satisfaction? And his answer to me was, Jim, I can tell you it's value, speed, and ease of use. And those are obvious. But his interesting point to me was, here's what kills a customer experience. And here's how you go on the J.D. Power customer satisfaction list from 860 on average, which is what Quicken and some of their close competitors are in terms of customer satisfaction, to 550 to 450. And Bill's comment was, Jim, think of it like this. It's a credit score. If you're doing really well, the best credit score you can get is about 850, and that's what we seek to achieve on customers. If you don't create a relationship with the customer, you're down to 600. That's the ceiling, not the floor. If our process is opaque or confusing in that customer's mind, we're now down to 500. If we break promises and we don't close on time, we're down to 450. And if we ask for the same document multiple times and just frustrate the customer, we're heading down even further. So one of the things that we have to do as a customer, as a company, and this is true not only of Quicken, but I believe of everybody that is in the mortgage lending business, is really hold employees accountable for service level and measure how long things take in terms of time between milestones, but most importantly, detect any driver of dissatisfaction very, very early. It's hard to do, perhaps, but it's actually, if you think about broken promises, it's pretty easy to do. Because of broken promises, I don't close on time, or I don't get the appraisal back on time, or I don't call the customer back as agreed. So if you really want to think about customer engagement and the profitability related to it, it really goes back to data-drivenness. It's how do you measure the value, speed, and ease of use, but more importantly, how do you detect the failure to create the relationship, the broken promises, the multiple requests for the same document, and a process where the customer doesn't know they're at. So we'll spend a little bit more time looking at some data in just a moment. But that is not only the discussions that Bill Emerson from Quicken has, but many of the other companies that I spoke for had similar themes. Susan Stewart from SWBC said the same thing. It's got to be connecting with a customer. Eddie Perez from Equity First or Equity Prime, you've got to really listen to that customer and make sure there are no broken promises. So among all those folks that you saw in the first slide, company-wise, that's what's on their mind. So that's number two. Number three is our fundamental problem, and it's cost per loan. So since 2009, we've seen cost to close a loan go from $3,500 to $8,000. And in 2018, it was even higher. The annual numbers aren't yet published, but it's going to be somewhere around $8,300, $8,400. if you think about that,
Hey, Jim,
on
I'm so sorry to interrupt there, Jim. I apologize. One of the things that I've seen a lot of our lenders struggling with is, this cost matrix keeps increasing. And then I think also the growing cost of compliance is really, a large component of this. But I was kind of curious, are there some other areas in which you see costs really increasing other than just compliance, sir?
Yeah, if you think of the labor, and thanks for teeing up that point. So that's the fundamental problem. Here's the issue, and it's not just compliance. It's the overall labor, and this is just the operational labor in a loan file. And about $1,000 of that is compliance, but there's $1,400 to create that pile of paper. So Chris, to your point, General Motors produces a Buick SUV with all-in labor costs for union labor of about $2,350. And the MBA data for operational labor to produce a retail loan file, essentially a stack of paper or a stack of documents, is about $2,400. This is kind of a tough issue in that here's how it comes out. So over the last 3 years, about 67, 68, 69% of the cost of a loan in terms of production was for people either in the sales, production support, or personnel side. And certainly compliance has added a lot to it. But the discussions that have come out of the book in strategic transformation are that there's more at work than compliance. We look at how many times a file is touched and how many times a file is reworked, or how many times an underwriter has to relook at a file. And the number of touches on a file are simply amazing. If you think of fulfillment personnel of being paid roughly $35 an hour, $40 an hour, $50 an hour, to get $2,300 of labor, if you divide that out, you're looking at 40, 50, 60 hours of touch labor to close a loan. Compare that to the cost of getting a loan when you buy a car. So you walk in to buy that same SUV at a Buick dealer. You pick out the car, you sit down. The finance and insurance guy says, how much do you have to put down? Generally, the answer is not much. Credit score, or name, SOCH, stated income, you get an answer in 15 minutes and you're driving the car away in an hour. That's the type of speed and decisioning that can be done for a car loan. And I understand we have securitization, we have secondary market, we have all those elements, but it doesn't really require us to double the cost of a loan in the last 7 or 8 years. The other interesting thing on this, Chris, to your point, is technology-related expenses. And this is not third-party fees that are passed to the consumer, but this is core technology, is only 2% of the total. So when you look at that, the argument may be we're underinvesting a little bit in technology. So Chris, I'm going to go back to you and to just kind of ask, does that solve the question, or does that answer the question? And then, to Bill, Ian, any other comments you want to make?
Yeah, no, I think that absolutely does, and I appreciate the breakdown here. And Bill, did you have a question about some of the numbers?
Yeah, I'm assuming that basically the third line from the bottom is basically a subtotal of the direct expenses and then the allocation, corporate allocation, adding up to 100. Am I interpreting it correctly?
Yes.
Yes. Great.
Yeah, and I think also, sorry, go ahead, Jim.
No, I said the interesting thing is that in looking at this on a disaggregated basis, the sales and production support compensation and the fulfillment compensation really have different root causes of why they've increased. But nonetheless, the level is pretty high, and the way that one kind of addresses the two different types of compensation have similar roots. It's really looking at efficiency. It's looking at how one can ultimately identify who's really efficient, going back to Billy Beane, who can produce runs and who can produce wins at the lowest cost. So Chris, anything else you want to kind of cover on that?
No, the only question, just going back to that technology question there that you had raised, that this doesn't include paying out third-party vendors that are providing technology. So an assumption could be that you're maybe underspending on technology-related expenses. Are you? What I find often within our client base is that there is an underutilization of existing technology. Frankly, I think, Jim, that's where you and I first met, working with a few of our clients at optimizing their loan origination systems or product and pricing engines. And I guess I'm wondering, since you work with a lot of different technology vendors out there, are you finding that a lot of folks are using that as an ability to control costs, or is that still being underutilized?
So great question, Chris. I think it's largely underutilized. And one of the questions our clients often ask us is, are there other things we should purchase to reduce our costs that are technology related? Or, we have an LOS, we're thinking of doing something different because we don't like the LOS.
Right. Yeah, Jim, I guess I'm sorry, Jim. Go ahead.
No, go ahead, Chris.
I was just going to add to that. I guess the real meat of the question is, hey, how the heck do I justify spending more money right now on when I'm my dollars are already tight? And I think you're getting to it right here. Is what are the drivers of that ROI that makes the technology really worthwhile, right?
Yeah, and it's really using the technology to take the cost out and to improve the customer the experience. And I think I'd like to just spend a little bit of time on that. So if you think about the top processors, underwriters, the clients that you have, how do you find those who are really the best? So if you looked at that 100 or so people there, how do you recruit more of the top performers? How do you coach the middle? How do you identify the low performing LOs? It's not just volume, same with processors, underwriters, and closers. So that's number 4, and we're going to look at that in a data-driven way in just a moment. And it's the same question there for how one goes through and looks at identifying revenue leakage and profit lost. How do you go through and identify all that? And how do you go through and identify the most profitable loans and do more of the green loans and less of the red loans? So kind of laying those two things that we'll look at in just a few moments, it's really the fundamental question that's what's holding us back. So if we looked at the cost where we are in 2018, one of the questions I asked over 125 CEOs of different mortgage bankers was, if we're at $8,300 in 2018, what's it going to take to get us to $3,000 in 2021? So the responses varied. The folks that I included in the book had some pretty clear ideas of how to do that. The folks that said, gee, I don't think so. I think the costs are just something that's going to continue. I didn't write much about them because I don't know that that's actually going to be a viable strategy. So if you think about how we go in the current environment from dealing with substantially lowering the cost and substantially increasing the profit and looking at the shifting landscape, what do we do? So what is that shifting landscape? Well, here's a look at home equity going back to 2000. And we all know what happened to home equity during the mortgage crisis in the middle of the chart. We went from about $13 trillion of home equity down to about $8. One of the things that's happened in the last 5, 6 years is home equity has come back. And interestingly, currently, as of the end of 2018, homeowner equity is about $14 trillion. And according to CoreLogic, about $6.5 trillion of that is lendable equity, meaning that equity is held by people that have income. It's not retirees that have fully paid off their mortgage. It's not people that put 100% cash and purchase the property because they have the liquidity. That $6.5 trillion is essentially our customer base that we serve every day that has that equity locked up. And one of the things that I think Bill might want to talk a little bit about is some strategies that might be used going back to increase profit potentially today. Because that $14 trillion of equities sits on top of $10 trillion of mortgage debt. And one way of looking at that is that about 80% of that debt has mortgage rates of 4 or less. So there's no opportunities for refinances, or are they? Or are there, Bill?
Yes, it's clear. One of the things we've talked to different lenders about increasing their profitability and evolving their business is the transition towards trying to get more purchase activity, which requires a diligent effort to build relationships with realtors in the lending footprint. One other thing to your point, Jim, is that with the amount of equity that's been built up over the years, cash out refis are, a lot of lenders don't tend to think of those in terms of an available source of business, and do the work and apply the analytics necessary to identify those borrowers. But it's a very good source of production, because first of all, it's not as price sensitive or rate sensitive as traditional rate and term refis. Sometimes when borrowers will take those loans, even if their overall rate doesn't, on the new loan, doesn't offer a rate savings, because it's a very efficient way to borrow money. You're tapping the equity in the home, which is the cheapest financing that's available. And also, to a large extent, not fully, but to a large extent, it's tax deductible. But it's certainly cheaper than tapping credit card finance. But trying to identify those borrowers requires some additional effort. But I think it's worthwhile to consider. The GSEs have certainly cooperated with this, and now both Fannie Mae and Freddie Mac offer LTVs up to 80% for fixed and adjustable rate cash out loans. So these are the kinds of things where you might be able to identify new sources of business and new sources of leads, where that's not totally related to or dependent on a borrower having a refinancing incentive. But it does require the some analytics and developing analytics to identify those borrowers and talk to them.
Yeah, great point.
Well, that's a
Jim, I'm sorry. I was just adding that was a great point, and I also wanted to share that I do see we have a few questions coming through, and we're doing great on time. So just to any of those folks that have added in questions, we will get to those questions as we finish up today. Sorry, Jim. Go ahead, sir.
Okay. So what we might do, I'm just going to pause the share for just a second and get an opportunity to perhaps just take a look at some data that comes from a client that is kind enough to permit us to take their data and use it as anonymized data set. And what we're going to do is take a look at a couple of things in terms of the item I mentioned about perhaps looking at a way that Billy Beane might be proud of looking at data. So you should see my screen right now. And what we're looking at is the actual data from a customer. What we've done is anonymized the cities, and they happen to be Major League Baseball cities. We've anonymized the data set, interest rates, a few other things, but the FICO, the LTV, all of the other aspects of this particular lender's data have been kept together. So the first question we might ask is, and what we're looking at on the right-hand side is a FICO score going from 600 to 800 with a weighted average interest rate that is associated with each of the branches. And the first thing we'll see, there are some outliers on the branches. What those outliers tend to do, and you see Philadelphia happens to be an outlier, in that the weighted average FICO score is fairly low given a rate that's similar to ones that are there. So if we took a look at Philadelphia and said, let's just look at Philadelphia in terms of the loan officers, we see something kind of interesting in which Martina White, which is this particular loan officer, has a 750 FICO. This is an average FICO for about 672, and then here's an average FICO of 513, but yet the pricing is relatively similar. So let's just look at Cecilia Becker and take a look at her loan. So now what we're doing is looking at, are there any outliers of the loans? And this happens to be an Encompass client. So all of these loans have Encompass loan numbers associated with them. The purpose of this is to be able to drill down and look at what are the aspects of the loans vis-a-vis the loan officer, vis-a-vis the branch, vis-a-vis the FICO and interest rate. So that's just a quick way. Go ahead.
Yeah, Jim, I was just going to say, and this actually goes hand in hand. I've worked with this product and have helped you install it with some of our mutual clients. And I always mess up the name, but I think it's Coheus, which is a product that you use to measure all of this. And I think it's another kind of getting us back to that kind of. Can you talk to us about the ROI that some clients have actually experienced by implementing this new technology?
Yeah, so I'll show you an interesting thing that comes out of a particular case. So this is looking at data where we have the credit box. Interestingly, we have the FICO distribution, the DTI, the loan to value, and how long things take by branch. And what we're looking at here is how long it takes to go from app to funding, to go from app to processing, processing to underwriting, underwriting to closing, and so forth. So one of the questions the client asked, and I actually asked back, was it takes 42 days to close and 60 days to fund. Does it change with higher credit loans? So the first thing we did was say, let's just look at everything over 750 credit score. And interestingly, the time to close doesn't change. And that was a surprise. So we then said, what happens if you use lower FICO or lower loan to value? So if we looked at loan to values, say of 50 or under, 60 or under, does the time get faster or slower? And amazingly, the time gets slower. It takes longer to close a loan with a 750 or higher FICO score and a 60 or lower LTV. And initially, the reaction was that just can't be right. But the data is coming right out of the LOS. So we began to look at that and say, well, where's it coming from? So here's Cincinnati, and Cincinnati is one of the drivers, and Rosalinda James happens to be one of the low performers with respect to time to close, being at 74 days. So when you start to look at this data, you start to find some interesting things that the averages may not necessarily convey exactly what's happening all over your company. So in looking at these loans that should be closing fairly quickly because they're pretty much slam dunk loans, one of the questions that came up is why. And the reason is this is a retail operation, and one of the causal factors was that the loan officers wanted to get the harder loans done or to get the fires put out. And what would happen is the easier loans were just kind of pushed aside. There was not a separate track to say, push the slam dunks through really fast. The other thing that came out is if you look at the top of this data strip, those loans were priced at 113 basis points of average revenue, which to me is just crazy. against the run of book of 287. So your higher credit score loans for which pricing was very competitive essentially were turning slower. And if you looked at fallout was actually pretty high. So I'm going to just jump on to something else here for a second, and that's to look at loan officer compensation and loan officer profitability. And then we'll just leave some time for questions. So here's a couple of things that you might do if you got at the data. The first thing is, this is looking at 525 million of closed production, 2,500 loans. The first question I have is, let's look at the bottom. So if we took the bottom loan officers here and said, what's the impact of the bottom 20 loan officers? They did 40 units for 7 million, and we lost 770 basis points on that $7.8 million. If you did nothing else but say, ladies and gentlemen, thank you very much, but you're now going to have the privilege of working for a competitor, 770 times 7 million is 600,000 runway, just added right to the bottom line. The other interesting thing is, what if we looked at the top 5? So those are the top 5, and they were doing roughly 20% of the business, but look at the revenue per loan, compensation, and contribution margin. That is much better than the average group, which was 333. So what if we looked at the top 5 branches and the loan officers within them? We're doing the same thing here. We're looking at those branches that produced 400 basis points of contribution, and interestingly, a relatively low cure amount. And here's all the loan officers that are in there. We could use that same selection set and then begin to go through and look at profitability by product. So those are the branches I have picked out, and let's just look at the FHA segment. So now I'm just looking at FHA loans, and you can see how that FHA contribution, or the contribution margin in terms of revenue, is high, but the cost of those loans is extremely high. So we began to look at why are FHA compensation costs so high. We also saw one branch that was exceeding in terms of FICO and profitability, doing really well. And we also noticed that Imelda Key, who is their top loan officer, just taking a look at what that particular loan officer is doing. So that loan officer was able to get 729 basis points on their FHA volume, was paid pretty well for it, no cures, good contribution margin. If we took that off and just said, what's the run of book for that loan officer, meaning all the other loans that they did, you can look at, the gain on sale went down because of the addition of conventional, but the comp went down, profit went up. So as you look at these types of combinations and look pretty deeply into all of the different branches and how they go out, you begin to see opportunities to ask the questions of, where should this be and what should we do it? We could look at things here in terms of either units and go to the top unit producers, the top volume producers. We can just go through and say, okay, let's again just look at the top 10. There's the top 10. They're doing 1/3 of the business and 504 basis points of total revenue against run of book of 514. So you get the idea. This information is actually drawn from the origination system, so you can see all of the detail fees and revenue coming in. You can look at the compensation elements. We can go in and look at the compensation by branch. This is MBA category, and this is the compensation schedule. So one can go through and say salary, bonus, commission, total comp, comp per loan, and you get the idea. So I'm going to stop here. Chris, I'm just going to go back to the presentation and really let you moderate for
some
the questions.
So one question we just had come in, I believe relevant to the last slide that you were showing there, was from Brian Edwards. Why is the compensation different by loan type? So Jim, I think some clients employ a straight across the board, and then some clients will diversify their compensation by loan type. Do you want to speak to that a little bit, or Bill?
Bill, go ahead if you want to start.
My sense is that there are different processes that are required for the different products. I think that's the biggest driver of it. The fact that you because of especially with the costs associated with problem FHA loans, for example, that will tend to add additional costs, I think, to the assumption that on an FHA loan versus a conventional. I'm curious, Jim, if that's your sense too.
So there's a couple of things at work here, and you're absolutely right as one of the causes. The second thing that we're doing is looking at how the compensation is paid by loan officers. And in some cases, the loan officers have different commission structures in different geographies. In other cases, the loan officer has a guarantee. And remember, we had some substantial underperformers at the bottom of that colorful chart in terms of loan officer contribution. So what you have there is that it's the combination of salary, guarantee, where they are in their cycle that really drives the differences in compensation. And what we're looking at is all-in compensation divided by all-in revenue to get contribution margin. And that's why you're seeing those differences. And what jumps out is that if one looks at contribution margin, and it's not the only way to look at it, but we use it because it isolates everything a loan officer or branch can do to generate and get paid the revenue, less the cost of actually having that person there, salary, bonus, incentive, fringe. It's the essence of what that loan officer is doing for you. So that's the reason you have different, it's not different commission rates, it's really different efficiencies. Think of it as baseball players that have different salaries and different productions.
Yeah, absolutely.
It comes down to cost per run.
Yeah, absolutely. So, Brian, hopefully that was helpful for you. I guess we're getting a good conversation here, and I think, Steve, thanks for joining there. It shouldn't vary by loan type, which is an LO comp violation. I think we might be getting a little confusion on what exactly, Jim, you're meaning when you display the LO comp for different loan types, right?
Yeah, so let's address that, because that's one of the most interesting findings, and I'm glad that people are asking those questions. So here's what's at work. The commission structures of this client and all of our clients are compliant. But what we're doing is saying we're not looking at just the commission structure. We're looking at what the all-in cost of that particular loan officer is. So if you have a guarantee paid to that loan officer and they're relatively new, that compensation will be higher in terms of compensation by loan officer than someone who's doing $100 million just out of, for absurdity, and is, well down in that compensation curve. But what we find, and this goes back to the data-driven business, is that when you look at contribution margin, you're getting in the essence of who is profitable and who isn't. And that's the key question for a data-driven business.
Yeah, absolutely. And we could spend all day talking about LO comp for sure. I want to jump back here. We have a couple other questions. Eric asked a great question about, are there any suggestions for measuring after hedge profit on a loan level? And Eric, that's a great topic. Phil Rizzori, our Chief Operating Officer, and one of the owners of MCT, actually penned a great white paper on loan level hedge costs. And so, Eric, what I'd invite you to do actually is, or if we can just jot down your name here, we'll get you that white paper. It's available, I believe, on our website too. Rick had a question, Jim, I think, about your description or definition of fulfillment personnel and what you were rolling into fulfillment personnel in your analysis on that case study. Great
question. So using the same definition that MBA uses in their mortgage banking profitability summary reports. So in the sales side, it's sales loan officers, it's producing managers, it is sales assistants, and other folks that are before the RESPA app or the RESPA date. Once the application is achieved, openers, processors, underwriters, closers, all of the people in fulfillment up to and through the shipping people are in operational costs.
Okay, great. I got another question for Bill Berliner here. Bill, what is the average pickup that you're seeing from a bid tape AOT?
I mean, generally speaking, the thinking is it's been measured somewhere between 4 to 8 basis points of savings, because you have, for example, you cut the pair-off costs. The bid-ask spread on a TBA is roughly a 30-second and possibly more, a tick plus, maybe 2 ticks, depending on the size of the originator and the size of the trade. So right there, the lack of a need to pair out of a trade is a savings right there, as well as the fact that when you do it, you are possibly shortening the length of time the hedge is on, which saves you carry costs.
Yeah, and I know I think what made this much more easy, nowadays is the automation of that tri-party agreement. So again, for any MCT clients that are on that aren't using bid tape AOT, feel free to reach out to your traders to continue that conversation, or again, you can feel free to reach out to Bill or myself too.
Also, there is an excellent webinar hosted by Phil Rizzori on the topic of the new bid tape AOT executions, how they work, how the pickup works, which ones are available from which investors. All of that is available on our website, featured prominently. It's called New Bid Tape AOT Executions Explained.
Okay, and then Jim, Bill's got one question for you here.
Sure, Jim, I'm going to shill a little bit for your upcoming book on disruption, and just ask you, based on your conversations and your general survey of the landscape, what is the source of disruption that might be on the horizon? Is it technical? Is it process? Is it regulatory? What do you think is going on in that realm?
So that's a great question, and there's a couple of things that I think are really opportunities for companies to look at how I can essentially creatively disrupt and grab a much larger share of the market. The first piece is similar to what Billy Beane did with the Oakland Athletics. Everybody knows the strategy. Everybody knows what he's doing. Michael Lewis wrote a book about it. Brad Pitt starred in the movie. But yet, in 2018, they got to the wild card game. Unfortunately, from Billy's point, they lost to the Yankees. But they got there on $68 million. So the question comes down to what's different about the A's, because their strategy is observable. Everybody knows what they're doing. And here's the 3 things that Beane told me. And this is where disruption, I think, opportunities exist for the industry. The first is, if you run a data-driven business and you truly believe that data informed by judgment, but data gives you the base place to start, you're going to go through and run a much more efficient company. Billy Beane told me an example about a hitter who said, I always hit fastballs. And first pitch, I hit it. But his batting average went down about 100 points if he swung at the first pitch, whether he hit it or not. The issue that Beane kind of pushed through is we have discipline. And we send them to the minors. And then we sent somebody else to the minors. And once people realize they're going to the minors because they don't follow our strategy, everybody else complied. And that's one of the things that gets wins at low cost. So from top of the organization, Billy Beane, to the bat boy, to all the players in between, discipline to follow the data is number 1. And that is disruptive, because this is not an industry that is data-driven. Many decisions, I talked to a friend over the weekend, and he said, we make a lot of data-free decisions, meaning we shoot from the hip. That's not a disruptive strategy. That is a destructive strategy. So data-drivenness is going to be one of the things of disruption. The second is data-drivenness doesn't mean you always win. There are seasons that don't go so well. You don't throw the data-driven strategy or the overall strategy away. You say there's statistical variation. Just like in hedging, there are some months in which you hit really well. Some months are pretty good. Every once in a while, you get a not so good month and it doesn't work. But that's just the nature of data-drivenness. And the third element that Dean said is consistency of purpose. If you really think about data-drivenness, you don't stop. You keep looking for those insights about where you can pick up 2, 3, 4, 5 basis points. You know, bam, I can pick up 4 to 6 basis points, 8 basis points there. In 2018, the third quarter had a 20 basis point gain or average after-tax profitability. If I could add 8 basis points to it and go from 20 to 28, that is a significant increase in profit. So what I take away is disruption isn't one big strategy. It's not one big bang. It's the hundreds of little things done consistently and reliably and from a process-driven and a strategy-driven standpoint, as opposed to data-free strategies. So
Jim,
that's a little tease for the book.
Yeah, I was going to say I can't really think of a better way to wrap up, and here we are sitting just a couple minutes over our time. So what I'd really like to do is thank everyone who attended. We had a great attendance record here. Remind everybody that the recording and the support materials will be distributed next week. If you have any questions for Jim or Bill or myself, of course, our contact information will be provided there. And I really want to thank Bill Berliner, our Director of Analytics, and Jim Deitch from TeraVerde, and everybody have a wonderful day. Thanks so much for participating.
Thank you, ladies and gentlemen. Bye.